And Rakesh Valecha, who's Senior Director and Head Credit and Market Research at India Ratings, joins us with the highlights of this report. Rakesh, good to have you on the show. Good afternoon. Why do you think there would be such a prolonged delay in earnings recovery? I mean, most on the street are saying perhaps 2 quarters or 3, second half of FY16. You're saying, well, not before FY19.
Yeah, that's right. I think, see, if you look at it, I think what we are trying to say is we are trying to look at the macro factors and then trying to assess as to where the earnings would be. And what you would probably notice in the report is that there is a strong correlation between nominal GDP and the kind of nominal revenues and EBITDA that corporates invariably report. Given what we are looking at, I think the drivers for profitability are by and large driven by investments or by government fiscal deficit or consumption which picks up, or maybe exports. Given that most of these pillars are not necessarily acting as a pillar of strength at this moment, by and large our belief is that unless private investment picks up, which we think will probably happen in the next 2 to 3 years, earnings growth by and large in that interim period will be dependent on government fiscal deficit. So if the government is something which is willing to expand its fiscal purse and allow more public investment to take place, realistically you could have earnings which could pick up in a more meaningful way in the interim period. But failing which, if the government continues on a fiscal consolidation path, realistically you'll have to wait for private investment to pick up for earnings to also pick up in a meaningful way. So we think that's going to be a bit distance away, and that's why we believe that the earnings growth, and when we say earnings growth, this is by and large the EBITDA growth, will probably be about 12 to 14% in FY17. Much lower than what we have seen post the GFC, as well as what we have seen in FY5 to FY8. And this is again contingent on the government actually loosening its purse.
Isn't that the plan, really, Rakesh? That the government would perhaps step back a bit on, on maintaining a tight fiscal consolidation plan? I mean, they're saying that you might just about meet the target for this year, but for FY17, FY18, within this budget, a roadmap would be laid where public spending would be accounted for a bit more, and that would push the overall numbers or the overall targets on fiscal deficit, widen them a bit for the next 2 years. So shouldn't we work with the assumption that if that's going to be the case, then we might see earnings, that trickle down to a pickup in earnings by the end of next year?
Yeah, no, I think our expectation is also the macroeconomic outlook that we have released today. We have said that probably the fiscal deficit next year would be about 3.9%. So to that extent, yes, we do believe that will happen. But I think what I'm really looking at is in terms of the actual value terms, the fiscal deficit growing by at least double digits. And if that happens, then only you get an earnings growth of about 12 to 14%. But if you grow by the, say, the single digit numbers that invariably would happen even with a bit of loosening, then you're looking at probably anything sub 10% growth even in FY17. So what this all means is that realistically your recovery is going to take much longer. Your deleveraging, especially for some of the capital intensive sectors, I think that will get pushed a bit behind, and which is where even the private investment will then probably happen sometime around FY19 is what our belief is.
Okay, and Rakesh would also like to know, in terms of sectors, which sectors do you think will see a better earnings versus other sectors?
Yeah, I think clearly the sectors which are linked to urban consumption, I would say, and sectors which are still focused on exports, while I think, as I said, exports is probably not still a pillar of strength, but just in terms of relative terms, those sectors which are focused on exports, I think these are the ones which will probably see a bit of an earnings uptick during the course of FY17. But sectors like metals and mining, oil and gas, and maybe cement to a certain extent could be sectors where you could have downside risk even in FY17.
Interesting note, Rakesh. So you're essentially saying that there would be some delay in private investment pickup, and so the overall earnings, the nominal GDP particularly, will not pick up as per expectations, and perhaps the whole cycle would get extended out by over 2 to 3 years. Thanks very much for joining us. and giving us that quick perspective on the report that came in.
Thank
Now,
you.
completely run out of time, unfortunately, on this interview. But just want to mark the markets before we touch base with our next management. We're looking at the index, still finding support at 7,400. The mid-cap and the small-cap indices are still under pressure, so down about 2% for the mid-cap index. The small-cap index is down about 2.5% as we speak. There's, of course, BHEL, a Tata Steel, a Tata Power, which are holding out. Some of the private banks are also pitching in. Kotak Bank is going to be coming out with numbers, so keep an eye out there. Axis Bank, Bank of Baroda are holding out. Among the key losers, and I just want to point those out as well, Europe is signaling that there might be some respite in those markets. But as we speak right now, there seems to be more pressure coming in. So Ken, Bajaj Auto, ONGC, Z Entertainment, those are the stocks which are losing out. We'll take a break then. When we come back, get you some more internals in the market.